Good Friday afternoon, folks, and welcome to this week's weekly commentary. Welcome also to a merciful end to a brutal week in the markets. And I don't know about for you, but for me, this week couldn't have ended soon enough. We are currently in the midst of a very challenging time for investors. Even though just a few months ago we entered the year looking at tariffs as the number one headwind for the economy and markets, with investors being confident that stimulus provided by deregulation and tax breaks in the big beautiful bill, along with high expectations for multiple interest rate cuts, would more than offset the negative economic impact from tariffs. Animal spirits were running high. Seems like a lifetime ago as all that has been thrown out the window beginning in February, with investor optimism turning to fear that AI would upend pretty much everything. Those concerns were beginning to fade a bit when the U.S. escalated the war with Iran. And I say escalated, not started this war, because while it hasn't been a continuously hot war, it really did begin about 47 years ago, and the aim this go around was to try to end the war once and for all. That effort, however, has brought on a host of new, potentially longer-term concerns. And I emphasize longer term, that is the next several quarters to a couple of years, because that's what matters most, not what is going on right now. Hindsight will reveal whether current fears are ultimately justified. For investors, however, hindsight is kind of a useless knowledge. So our job is to figure out as best we can now what current events will mean for the longer term. And currently, oil prices are elevated to crisis levels. And because of that, fears of higher inflation, higher interest rates, and lower GDP growth, even recession, are rising. Speaking of interest rates, the odd for rate cuts for 2026 have dropped to near 0%, while now odds for at least one rate hike have jumped to 50 to 60%. Should all of these fears become reality, then yes, it's likely we're going to see a recession and a bear market. But the question for all of us then is, will these current fears be realized? Or will issues giving rise to these concerns be resolved before the worst case fears do become reality? Now, arguments can be made for both scenarios. History, however, they say it doesn't repeat but it rhymes. From a technical standpoint, recent history can give us maybe a little bit of comfort from both 2022 and even last year. In 2022, while the fears of a deep recession or even any recession were never realized, markets nonetheless suffered worse declines than we've currently seen so far this year as investors waited for that ultimate acknowledgement. Subsequent to that downturn, the S&P 500 rewarded patient investors with an 85% rise over the following 3 years. Now, just a year ago this quarter, we were actually in a very similar situation with the S&P 500 as we find ourselves today. Early last year, the S&P 500 experienced a roughly 9% decline from its late 2024 highs, that sell-off being based on the higher for longer mantra that the Fed was selling us. Then, shortly after, came the Liberation Day wipeout, and despite that painful selling over that period, the S&P 500 ended last year with an 18% gain and a 36% gain from those early April lows. These are two recent examples of the importance of trying to determine whether short-term fears and market activity are presaging a recession and bear market, or whether they are going to produce only a short-term correction. And having a confident opinion, I should say, as to which outcome is more likely is what guides wide decisions. Investors who tried to time either of those two recent volatile events likely fared worse, maybe far worse, than those who maintained their discipline. Now, with the bear market being technically described as a decline of 20% or more from recent highs, then technically both of those recent episodes actually go into the books as bear markets. During 2022, the S&P 500 very briefly touched on a 25% decline before rallying into the end of the year with only an 18% loss on the year before then rocketing back to new highs. Last year, for literally a couple of minutes in April, the S&P 500 did touch on a 21% decline before it again rallied 36% from that low to end the year with a very nice gain. Now, during 2022, while I was frustrated that what I perceived was irrational selling at the time, I was confident the losses would be short-lived and no bear market or recession was in sight. That confidence stemmed from paying attention to the economic data and realizing there never was any real data that pointed to a looming recession. Last year, I was even more confident that the Liberation Day sell-off would likewise be short-lived. I remained confident at that time that the president would ultimately back off those punishing tariffs and that he had the ability with a few words to reverse the selling, which is exactly what occurred. Currently, I'm working on gaining a level of confidence as to which way existing current events will break. Is it going to be a short-lived yet perhaps more painful correction, or recession and bear market? Now, while the president remains sensitive to market and economic activity and will likely do his best with at least rhetoric to prevent a worst-case outcome, he's in less control of current market-moving events than he was with Liberation Day tariff fears. The longer oil prices remain elevated, perhaps the new higher for longer fears, is the greater likelihood of inflation, higher interest rates, and recession. That is, higher inflation, and ultimately then a bear market. And oil prices will remain high and unstable for as long as the Strait of Hormuz remains closed. And reopening the strait is more complicated and more difficult than is the president simply making public announcements of a change of approach, such as he did with his Liberation Day tariffs. Why? Because Iran is currently in control of the strait. At least it is for now, and it could well be for a period of time that would be enough to tip the global economy into recession. Now, it does appear there are negotiations perhaps taking place to try to bring about a resolution to the strait sooner than later. However, given that it's unclear with whom even to negotiate, and that with whoever it is we're negotiating represents a truly barbaric regime that could care less about inflicting pain on their own people, to say nothing of the rest of the world, I'm not sure how fruitful diplomacy could be, at least in reality. And I believe we can take virtually nothing from the rhetoric coming from both sides. And that is a problem for the president, I think. His words aren't going to do what they have done in the past. Both sides are giving signals to their own people, and both sides are trying to control the time frame of the war through rhetoric. The president is trying to calm markets to buy more time to complete the objectives, while the Iranians are doing their best to spook markets and inflict enough economic pain to force the president into a quicker out. There's currently a lot of pressure on the president to both complete the job, ensuring Iran doesn't emerge again in a few years as a global threat to peace, and to do so without causing a global economic recession. And it's still too early to understand whether such an outcome is achievable. And if it isn't, and if the president should decide to favor completing the job over the economy, then even with that, I believe we're going to have more time to evaluate that possibility, while at the same time, through rallies, short-lived as they may be, possibly have a better exit point than we currently have, should that become necessary. Now, at the moment, there's still time to simply take a deep breath and realize that whatever exogenous or black swan events occur, the knee-jerk reaction is always to fear the sky is falling and to sell everything in sight. We're seeing that play out over the past month or so, particularly this week. And while I've run out of time and space to address another ongoing concern, and that is the AI impact on markets, which this year has been only negative, I'm going to do so next week, hopefully without too much distraction from Iran. One quick observation along these lines to leave you with this week relates to Microsoft. That great company is experiencing its worst quarter since the fourth quarter of 2008. Now, to refresh your memory, during that quarter, there were justifiable, rational fears that the world was about to enter a global recession to rival that of, global depression to rival that of the 1930s. And they were at its peak during that quarter, those fears. It may be worth noting, however, that a dollar invested in Microsoft at the low in that quarter, today, it's worth $26. In any event, it's certainly a challenging time, and more than ever, we're going to be doing our best to assess what it means. However, what we're not going to do is panic and sell into what currently is overblown fears. We don't know what's going to happen down the road. We do know that nobody knows, and therefore the fears, the knee-jerk reaction is what it typically is, and again, that's to sell everything. We will again keep monitoring this very closely and keep you up to date as best we can moving forward until we can come to a reasonable conclusion as to what we do believe is coming next. In the meantime, I hope you enjoy your weekend.